Okay, we're right up to number 10 in our lectures on money, and today we're going to sort of review certain things and look at some things that we've talked about in the past, but just as a reminder. But we're also thinking about the future. Where are you going? What are you going to be doing with your money? What are you going to be doing with your life? And we'll talk a little bit about government and money, but we're talking about you really and what's going on. Just as an indication, this is where we're going today in this lecture. Why save? Bank accounts, a savings account, ISAs accounts, pensions and budgets. That's what we're going to be talking about. First of all, why save? Well, why save? As time goes by, maybe we need money. Why do we need to save it? That's a good question. Well, we need to save to make sure we can buy things we need up the road. So if you're going to spend all the money that you've got today, and some people have to because they have to do that to live, but actually if we can save, it's very useful. We might be saving for our house up the road, and even though the mortgage company or the bank will give you a mortgage, you probably will need a deposit to add to that mortgage. Vacation, if you want to go on holiday, maybe you should be saving for that. Maybe you should be saving to go to college or university. Maybe you should be saving for your pension. What happens when you can't work anymore and there's no more income because the job's gone? Well, these are some of the reasons that we may think we need to save. Deposits, they're needed for a house. Usually building societies and banks will not lend you 100% of a loan if you want to buy a house. They'll say we want 10% or 20%, and you have to find that yourself before they'll lend you the rest of the money. Many will argue that people need to save for when they get older. Maybe you do. But listen, if you're thinking about saving in pensions and funds like that, always think about inflation. People forget that funny thing that happens all the time. And you look over the years, remember my story about how much a bag of chips cost when I was little and how much fish and chips cost today. That's just one illustration of how inflation has affected those things. They're still a bag of chips and a piece of fish, but look at what inflation has done to the actual price. Second reason, bank accounts, savings accounts. How do we save? Well, we've talked about bank accounts a great deal, haven't we? A savings account really is just a deposit account. Almost all banks do them, and even the post office will supply you with one. And don't forget those premium bonds from Ernie, because he can save you money. Although, again, remember inflation and remember that you're losing your interest if you go to Ernie. ISAs, it's another way of saving money. Individual savings account, it's tax-free. The government is saying to you, we will allow you not to pay tax on an ISA. We want to encourage you to save your money, and we'll allow you to put your money into an ISA, and we won't charge you any tax for the interest that you've earned. However, you're only allowed to put so much in it, and that money will be probably invested in stocks and shares, and the good managers hopefully earn you enough money that goes back into your account and keeps your interest going at a good rate. So an ISA is a good idea. Actually, it's a good way of saving, is an ISA. The ISA allowance, actually, I was saying the other day when I was talking to you, I didn't know what it was. At the moment, in the UK, you can actually save up to £20,000 in a year. Anybody got a spare 20,000? Well, you can put it in an ISA and it will earn you interest and you won't have to pay interest on it. If you leave that £20,000 in an ordinary bank account or a savings account or a deposit account, you will be charged interest on it, at least if you're earning enough money. But to pay tax, you will be taxed on it. There are two different kinds of ISAs, and personally I have to say I really get confused with this one, but there are what's called cash ISAs and ISAs that are not cash ISAs, so they're invested in the stock market. And they seem to me, when I've looked at them, that they work very much the same way. The only thing with the cash ISA is it has the same kind of allowances, but you can get your cash out slightly easier than a non-cash ISA, and probably that is the benefit. So if you need your cash tomorrow and it's in a cash ISA, you can get it out, whereas a non-cash ISA is a little bit more complicated. You can actually still get your money out, but it's a little bit more difficult. ISAs don't work on a normal year. It starts from when you put your money in and finishes when you take it out. So it's on a 12-month basis, but not on what's called the fiscal year or the financial year, which actually doesn't match our calendar year either. In the UK, the financial year starts on the 1st of April and finishes on the 31st of March. So your tax and company accounts and all things have to be up to date by the end of March for the previous year. So don't think, if you're thinking years, think fiscal year, which is 1st of April to the 31st of March.